Hello and welcome. I am pleased to introduce Bill Wilson, CEO of Townsquare Media, Stuart Rosenstein, the Chief Financial Officer, and Claire Yannicke, Executive VP of IR. Before I turn it over to Bill, Noble's analyst Michael Kopinski views Townsquare as one of his favorite stocks, offering a compelling total return potential with a current annualized dividend yield of nearly 11.5%. The shares are rated outperform with a $21 price target. And with that, I will turn it over to Bill.
Thank you, Patrick, and thank you all for taking the time today to learn a little bit about Townsquare and our progress to date. We'll be doing some prepared remarks through our investor presentation for about 10 minutes, and then we'll open it up to any and all Q&A that you can ask into the chat, any question you may have. I put the first slide of our investor deck up because this is how we think about our company, and I won't read the full slide to you, but the key takeaway is we've transformed a legacy broadcast radio company into a digital-first local media company. Over 55% of our company's revenue, and importantly, over 55% of our company's profit is being generated from our two digital divisions. And those two digital divisions are highlighted here. The first one is Townsquare Ignite, which we'll get into more detail, but it's our digital advertising solution, which is comprised of a proprietary digital programmatic advertising stack, as well as monetizing a robust local audience of over 400 mobile apps and local websites. The second digital division is Townsquare Interactive, which is a SaaS-based, subscription-based business focused on digital marketing services for businesses outside the top 50 markets in the United States. We're focused on scale and efficiency, and you'll see that throughout the presentation. So just a quick snapshot, you could see we're a community-based digital company that also includes robust broadcast radio assets. We have on a trailing 12-month basis, $101 million in EBITDA with over $450 million in profit. And as you'll see on the left-hand side of the slide, as I just highlighted, over 55% of our company's profit and revenue is coming from these two digital divisions. The other important aspect of our company to recognize is we operate exclusively outside the top 50 markets. We're really the only local media company, not only in broadcast radio, but if you think about TV, outdoor newspapers, direct mail, there's no real company that's focused on markets exclusively outside the top 50. And we think that's a competitive advantage for us. We think we've built a competitive moat. We think we understand the psychographic and demographics of these communities, and couldn't be more proud of that. As Patrick said, on the bottom right side of the screen, you'll see we have a very robust dividend. As of the close of business yesterday, in terms of the stock price, it's almost a 12% dividend, paying out 20% each quarter. So I won't go through all these stats, but what started as a traditional broadcast company in 2010 with 100% of it revenue in broadcast has transformed into a local first digital media company, not only from a revenue and profit perspective, but you can see on this slide, everything from an audience perspective, our social platform, our first party data, which is incredibly valuable, has really transformed this company into a digital first local media company. So taking a quick snapshot of a view from the top, as we like to say, you'll see our two digital divisions, Ignite and Interactive. They generate $237 million on a trailing 12-month basis of revenue. That's generating over $64 million of profit. Again, I think one of the things that also differentiates Townsquare is that our digital profit margins are actually just in line, if not higher than our broadcast profit margins, which I'll highlight on a couple of slides from now. So as there's clearly a secular share shift from traditional media, and that includes broadcast radio, broadcast TV, outdoor, and so forth, into digital, we're actually capturing a higher profit margin as that transformation happens, because we have, in our view, the best digital advertising and the best digital marketing solutions in our market. So when the share shift happens, we're actually able to keep the advertiser with us, grow their spend, and increase the profit margin for the company. You'll see on the right side, our legacy broadcast business, we're treating this as a traditional cash cow. We expect this business to continue to decline moderately. It generated just over $50 million of profit on a trailing 12-month basis, and that includes the political contribution last year, which was pretty robust at about $13 million in political revenue. Let me talk about the profit margins that I was just describing. If you look on the right side of this slide, you'll see that our total digital profit margin is 25% for Q1 of 25. Our broadcast advertising profit margin was 20%. If you look at just our digital advertising profit margin, it was 21%. So as I just said, as people share shift out of broadcast, which they're clearly doing, and we believe will continue to happen, we're actually making a greater profit margin by that share shift. The other thing I would share is that although our broadcast advertising has been declining, last year declined 6% ex-political, our actual broadcast profit margin ex-political was higher in 2024 than 2023. So as the revenue comes down, we have been able to demonstrate quite effectively that we're able to moderate the expense base in line with the revenue. And we'll be continuing to do that in 25, 26, and 27. As I mentioned, I cannot overemphasize how important it is to be in smaller markets and markets outside the top 50. We believe radio performs differently in that market. For example, our radio reach just through AM and FM signal is over 50% of the adult population on average in our 74 markets. So just through our AM FM signal, we're reaching half the adult population, which means we're also reaching business owners as well. And that is incredibly differentiated. In the top 25 markets, the greatest market share would be 25% penetration, and we're at double that, 50% penetration. The other thing I would say as it relates to being outside the top 50 markets, our digital marketing solutions in Interactive and our digital advertising solutions in Ignite are highly differentiated. We're bringing national scale and sophistication to smaller markets in the United States. And that's why you're seeing the differentiation in our digital results as well. We have, more often than not, the largest sales team on the street in our 74 local markets, larger than the television station, larger than outdoor, larger than any agencies out there. As you know, today, digital advertising is capturing over 70% of all local advertising spend. So we're in the right area in terms of growth. And again, as I said, we believe we're highly differentiated. You can see we've had a 13% digital revenue growth from 2016 to 2024. And this year, our growth continues to strengthen. In Q1, we were up 6% in digital revenue in Q1 over prior Q1. If you think about us as a traditional broadcaster, either television or radio, which we do not, we again view ourselves as a digital first local media company, but sometimes we get lobbed into this neighborhood. We have a slide that just shows that we have the largest percentage of revenue against the broadcast peers. We're at 57%, and you could see the industry average is in the mid 20%. And this continues to grow. 4 years ago, this was below 40%, and we believe in 4 years' time, this will be over 75% for Townsquare. Not only revenue, but as I just mentioned, profit profile is actually higher. We're generating a greater percentage of profit for the company than the 57% here. So digital advertising, we call it Ignite in our segment, comprised of our programmatic stack, which is serving the right advertising to the right person at the right time. This is across connected TV. This is across social. This is across any internet connected device. Fastest growing segment in programmatic is streaming TV for the industry. And that holds true for Townsquare. Our fastest growing digital advertising in the programmatic space is streaming TV. 5 years ago, we couldn't sell a television commercial. Today, it's the fastest growing part of our digital advertising. Second fastest growing part is social advertising. So that would be TikTok Reels, Instagram Reels, Facebook advertising across the board. And then obviously serving video ads across any connected device. The second component, so 60% of our digital advertising is programmatic, fastest growing for the industry, fastest growing for Townsquare. The other 40% of our digital advertising is monetizing our owned and operated footprint, which is quite fast. We believe we have the largest audience in our size markets in the 74 markets. And as you'll see at the bottom of the screen, one of the core differentiators that we began investing in over a decade ago is capturing first-party data that is providing the most valuable insights into audiences in our communities. And that is helping us from an advertising standpoint, it's helping us from an interactive standpoint, and it's really helping us stand out because not only are we doing digital advertising very well, but we're an at-scale publisher getting great insights into our consumers and our clients' audiences, which is highly differentiated in any market, even more differentiated in markets outside the top 50. Townsquare Interactive, this is our SaaS-based subscription business. We're doing everything from creating websites to driving incremental organic traffic to those websites, then converting that traffic into customers. We've launched a number of SaaS-based solutions like a CRM. So we're now capturing information, be it email, be it text-based information about visitors to the website on behalf of the client. We're then turning around and doing text-based marketing, email marketing on the client's behalf. We're handling all their social profile. We're doing reputation management. We're also, if they'd like us to do, doing invoicing for their clients, integration into QuickBooks. As I said earlier, this is a subscription-based business with over 20,000 subscribers. After a setback in 23 and 24, where we had a return to work mandate, so we had a lot of people who chose not to return to work in this division. We also changed our whole service model to create greater scale and efficiency, which created some short-term negative impacts, which we knew would happen, but we believed it would serve us well for the next 5 to 10 years of growth, creating scale and efficiency. And that's exactly where we sit today on June 4th of 2025. Townsquare Interactive is back in growth mode in terms of revenue and profit, where it didn't grow revenue and profit for the last couple of years. This year, our profit growth, we believe, will be one of the best ever in the division. So again, not only important for 2025, but more importantly, we believe the pain we took in 23 and 24 in the interactive division by retooling our service model, making people come back to the office, has served us quite well for 2025. We believe it'll be one of the best profit years in this division in the last 15 years. And then we believe that we're well situated for growth over the next 15 years. This talks about the TAM for interactive. It's in our investor deck, but we believe there's 9 million target customers, all outside the top 50 markets, all with employees, less than 20 employees, less than 5 million in revenue. And that gets you to a $32 billion addressable market in our view. So we're just getting started, and we're glad we retooled the service model for the next 5 years. I'll touch on broadcast. Again, we're treating this as a traditional cash cow, but we love the characteristics. As I said earlier, reaching over 50% of the population, which is, again, highly differentiated from other radio companies. Our time spent listening has been solid. As you can see on the right side of the screen, our time spent listening has been incredibly solid, and our audience has been solid, which is quite different than the broadcast industry at large, where time spent listening has been cratering. Our time spent listening, because the competitive dynamics outside the top 50 markets are highly differentiated. Again, we love the characteristics of the marketing, and we love the free cash flow. But at the same time, we recognize this is a slowly declining asset, and our growth engine is interactive, and our growth engine is Ignite. This is what we said we'd do in Q1, and this is what we resulted in when we did our earnings call. I believe it was on May 8th. Our guide was 98 to 100 million of revenue. We came in almost exactly at the midpoint at 98.7, and we actually overachieved our profit guide of 17 to 18 with 18.1 million. If you look at our full year guide, and then I'll pause for questions that you may have. So if you have any, feel free to put it up in the chat. Our Q2 guide, in essence, implies a slight decline in net revenue ex political, and we believe will be either flat to a slight positive profit increase on the ex-political side. But our guide is -1 to -3 ex-political on revenue, and -2 to +2 on ex-political profit. On a full year, ex-political revenue, we expect to be slightly down to +3%, and on profit, potentially slightly down to +8% on the profit side. As we get into the Q&A, we could talk about our refinancing of our debt that Stu just successfully did in February. That gives us the next 5 years of runway with our bank debt locked in. But with that, Pat, I want to make sure we leave ample time for questions, so I'll pause there.
Thank you, Bill. Yes, the first question is whether if you could add some color as far as Townsquare Interactive and the outlook goes. Subscribers have increased, but yet you're expecting, I guess, modest revenue growth for 2025. What is holding back revenue growth? What do you anticipate will be the longer-term revenue growth rate for that segment? Should more normalized revenue growth return in 2026?
Yes, great question. Thank you for whoever asked that. So couldn't be more pleased with the work the Townsquare Interactive leadership team, as well as the whole team, has done over the last 24 months, and in particular the last 12 months, going through a transformation and evolution of that business and really building up the service model from the ground up. Took a lot of hard work, took a lot of courage, to be honest. We could have just stayed the same path, but we felt it was the right thing to do for the long term of the business. So as I briefly mentioned, I believe as we sit here today, it'll be our greatest profit year in Townsquare Interactive in terms of profit margin, as well as just absolute dollar profit growth. Whoever asked the question is correct. Our revenue performance will be significantly muted against that profit performance, because when you think about a recurring revenue stream of subscribers, which we love, what's transpired over the last 24 months has a much greater impact on the revenue over the next 12 months than what's actually happening today, because we lost those subscribers over that time period. So you're seeing that in the revenue. The other thing I would share is that in the beginning of this year, we retooled our sales expectations and raised our sales performance standards of our salespeople at Townsquare Interactive. As a result of that, the great news is we're getting much greater ROI per salesperson, significantly greater than our historical. The downside of that is we've shed some underperformers that maybe historically were not underperforming because the standards were lower. So we raised the standards, we got a much higher ROI, but we've shed some salespeople. So the sales velocity has been muted because the number of salespeople has decreased, but our profitability has really grown substantially. As we reported in Q1, one of the highest profit margins we've ever had. In Q1, we grew profit over $1 million in Q1 over Q1 of 24. And then as we continue to build back the sales team, we're obviously aggressively hiring across all fronts, but we've got our Phoenix office and our Charlotte office. Those sales will come back through greater sales performance, as well as adding more salespeople. You're going to see that more in 2026, 27, 28 than you're going to see it in 25. So the last point of that question is, when will we return to our historical revenue level, which was about 8 to 10 million top line when you look at the last 12 to 13 years? We believe we'll return to that in the back half of 26, if not sooner.
Excellent. And our next question takes us to the balance sheet. Debt levels are coming down, but are still relatively high. Do you largely anticipate growing into those debt levels? Where would you like debt leverage to be, and when do you anticipate getting there?
Yep. I'll turn to Stu in 1 minute to talk about our debt pay down and what we expect it to pay down in terms of dollars this year and next year. Our goal is to get back to under 4 times. We ended last year at 4.3 times. Obviously, with our EBITDA going from 100 million last year, if you call our midpoint this year at 94, our leverage is ticking up as a result of that. So I think we were at 4.67 at the end of Q1. We think that'll tick up throughout 26 because of the political profit coming off. But our goal is, and our capital allocation priority is, to use our strong cash flow from operations to pay down debt. That's our number one priority in terms of capital allocation, outside of continuing to do organic investment in our digital divisions. Our long-term growth, call it years 3, 4, 5, is to approach 3 times leverage. But Stu, will you step in and just talk maybe for a minute about the refinancing, but more importantly about how much debt we expect to pay down in 25?
Sure. So unlike our previous debt structure, which was a bond, we did a bank loan, a term loan B. We're able to pay down without penalty at any time, daily, weekly, monthly, quarterly. We plan on paying down approximately $20 to $25 million a year this year, and hopefully a little bit more next year. We have required amortization payments this year of $8 million, but we will make at least 20 and hopefully closer to $25 million by the end of December.
Thank you, Stu.
Maybe just a quick follow-up to that is do you feel that the debt troubles of the radio industry more broadly are an overhang for your stock, or is this just the general market for small cap stocks and economically sensitive stocks that might be holding back your stock?
Yeah, I think the latter is a small part of it, being a micro cap and people taking the time to understand their company and digging in. And obviously, Noble's been a great partner in your research on that front. I think the bigger issue is being classified in a neighborhood that we don't believe we live in anymore, which is the radio industry. And a large number of those companies, highly levered. A number of those high profile companies have either come into bankruptcy or come out of bankruptcy in the last 5 years and are in a much different position from a balance sheet perspective, but more importantly, from a strategic perspective in terms of their assets and what our strategy is. So, our stock a year ago was 12.5. We started the year about 10. Right before Liberation Day, we were 15 to 20% higher. So I think all of those things have brought us to this point where our equity is far, we believe, undervalued, as does Michael with his price target that you mentioned at the top, Patrick. That's one of the reasons we put the dividend on, really for 2 reasons. One, to reward our shareholders while they're being patient and supportive, and also to highlight the strong cash flow characteristics that we can not only continue to maintain the dividend, we just increased it at the beginning of this year. We hope to increase it every year moving forward, while at the same time paying down debt, not only what Stu just said in the 25 million that we expect this year to pay down and more next year. Last year, we retired almost $40 million of debt while still having a very high yielding dividend. So going back to the original question, Patrick, we believe we're being penalized by being looked at and lumped into a group of companies that we don't belong in. And I think the second component, which is much, much smaller, the minority, is being a micro cap. Obviously, right after Liberation Day, recession odds, spiked up to 70%, have receded back to where they were at 25%. ADP came out this morning with some, subpar job numbers. We'll see what Friday brings, but clearly we believe rate cuts are coming. If that's going to be the first one in September or the first one in December, whenever it is, I believe looking at the next 12 to 18 months, there'll be rate cuts coming, which will help us overall from a company perspective, but also from an interest expense perspective. As Stu said, our instrument is now floating, which is great. So Patrick, I'll turn it back to you.
Excellent. And I think you answered the next question we had, which was around the company's commitment to the dividend. It sounds like you're firmly committed to that, or correct me if I'm wrong, but that seems like you already answered that one. I guess the next question we have is, what are the opportunities to land a significantly large station group? Do you have some thoughts on how much your white label Ignite business may contribute to segment revenues in the next 3 to 5 years?
Great question, and thank you for asking that, because I didn't mention that in my prepared remarks. We launched a media partnership division, starting testing in Q1 last year of 24 with one group in one market. We expanded that with Summit Media in October with 9 markets. We then added Steel City with 2 markets. We've signed up a 4th. By the time we announce our Q2 results in August, we believe we'll be announcing a couple more partnerships that are close to signing. And the pipeline is significantly robust. Literally over a dozen companies we're in active discussions with, where they're approaching us to white label our programmatic solutions. So we couldn't be more excited about the opportunity in this division of Ignite. In terms of long-term, meaning 4 to 5 years, we believe this will be a $50 million top line division at a 20% margin. So call it 50 million top line, 10 million bottom line in 4 to 5 years. This year, we expect it to approach about $7 million of top line, a little over $1 million of incremental profit. Couldn't be more excited about this potential. Really pleased with our partners to date. Couldn't be not only great partners, but they're out there telling others in the industry, be it radio, television, outdoor, newspaper, what a great partner we are. So that's actually increasing demand of people coming to us for this offering.
Excellent. And then could you also talk about, on the programmatic side of the house, any key advertising categories, connected TV, some of the drivers there?
Yeah, so no one category is an outlier for us in advertising, be it broadcast advertising, digital, programmatic, owned and operated. But as I mentioned earlier, and this person is asking in their question, streaming media is on fire. Streaming TV. As you know, cord cutting is at an all-time high, which is great for us in 2 ways. We're now the #1 reach medium in broadcast, but we now have a tremendous opportunity to be selling television cable commercials that we never had before. And in our size markets, with usually the largest sales team and a differentiated programmatic stack, we are very well situated. We're also doing all the creative. I mean, one of the reasons that these media partnerships are coming to us is we do great creative in-house, including streaming TV. So we feel very well situated. So streaming TV, fastest growing, second fastest growing is social, as I said before. And then third fastest growing is just video, video on desktop, video on mobile apps, so forth and so on. So no categories stand out, but those three in general, in terms of areas of digital advertising, are progressing quite nicely and accelerating.
Excellent, and that takes us to the end of the Q&A. Unless Bill, if there's any thoughts you'd want to leave investors with before we close.
I appreciate your time, Patrick, and I appreciate everybody's time who took the time to join live, and anybody who may watch this on demand. I would just encourage you to download our investor deck. I would encourage you to read our shareholder letter that we published in March and placed on our website. And again, to the questions you've heard here, often where the people who aren't doing the research, taking the time, may think about us how we were 10 years ago, which was primarily a broadcast company. Over the last 15 years, we transformed, we've evolved. We are now a digital-first local media company that we think is highly differentiated with our assets, highly differentiated with our strategy, and highly differentiated being outside the top 50 markets. So thank you for joining us today.
Thank you, everybody.